Coming up on today's show, Trump bangs gong signaling another increase in China tariffs. Democrats worry Trump may not have China's best interest at heart, and liberals devastated as stock market recovers. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks tumbled on Thursday, pulling back from the previous day's historic rally amid concerns that President Trump's broad trade offensive has become a direct confrontation with China. And today was a very red day across the board, led by selling in some of the big tech names: Apple, Nvidia, Google, Microsoft, Meta, Netflix, Oracle. All of these stocks got sold, including Amazon, including Tesla. As you can see right here, Tesla was down 7%. However, we did see buying in a number of names. For example, United Health, and these health insurers were actually very green. Communication services, this is a defensive sector, was very green today. You can also see your waste management. These are very defensive industrial stocks. We also saw buying in stuff like Walmart, Costco. These are consumer staple stocks with a growth component. You love to see that. Some of the other retail trade names were also very positive. And then we go up here, stuff like Procter & Gamble and Coca-Cola. These are consumer staple stocks that are generally considered defensive, as well as stuff like McDonald's, CME, right, PGI Insurance. These are defensive names through and through, and the defensive names led today. The cyclical and sensitive names were sold off. Consumer staples was the only green sector today, up 0.3%. However, beating every single equity index was gold, up 2.4%, and that is after yesterday's rise of 3.6%. Gold is absolutely ripping on policy uncertainty. Every other sector was red today, led by selling in energy because crude cratered, and technology, with the S&P 500 down 4.3%. And we saw selling in mid caps, small caps, and large caps, value, core, and growth. There was selling across the board. Nowhere was safe because President Trump and his team came out and clarified and said China's tariff is actually 145%. This wasn't escalation. It was simply just Trump and his team clarifying the fact that, hey, it's not 125% tariff. Once we put everything together, the actual tariff on China is 145%. And as a result, that puts the effective US tariff rate at about 27%. And this is still going to do major damage to the US economy, according to Yale Budget Lab estimates. However, guys, despite what we're seeing with these tariff numbers right here, the market played its hand yesterday. And the second we get any type of de-escalation, which I do believe Trump's next major de-escalation move is going to bring the Chinese tariff rate down to 100%, right? The second we get that type of de-escalation, markets are going to rip to the upside. And a lot of the big players are already positioned for that, and I'm going to show you in the data. However, we continue to see escalating global conflict. Bessent and his team, the Treasury Secretary, came out and said, we're not going to rule out even delisting Chinese stocks. Tickers include stuff like PDD, BABA, BABA, JD, CMTX, Camtex Holding. There's a ton of Chinese stocks listed on the NASDAQ, listed on the New York Stock Exchange to extract capital from the US and help their market. And Bessent says, hey, look, if things don't escalate, we are going to delist these Chinese companies. So we continue to see an escalation of trade tensions, particularly with this 145% tariff rate and all of the rhetoric we're seeing. However, there was some good news today. We got the latest CPI data and it came in cooler than expected. However, it kind of got brushed under the rug. The core inflation rate on a year-over-year basis came in at 2.8%. The headline figure came in at 2.4%, and this is on the back of actual deflation on a month-over-month basis of negative 0.1 versus the consensus expectation of a 0.1% increase. The core inflation rate increased 0.1% against the consensus 0.3%. And then we also saw initial jobless claims come in exactly in line. And everything we're seeing right now, the labor market looks good. Inflation looks good. However, this is all of the data before Liberation Day tariffs. And from May and April, the month onwards, that is what we need to pay attention to see if we do get deterioration in the US economy. However, if the data continues to do this, especially in the inflation picture as well as the labor market, I think that just points to a very robust US economy. Now, looking at some market movers, Constellation Brands reported their earnings, and they actually reported pretty good earnings. They were up 0.45% on a day where the market absolutely got destroyed. So it really goes to show that the market did like these earnings. And that's because they reported earnings per share of $2.63 against the street's expectation of $2.33. That's a very, very nice beat. They also announced a $4 billion stock buyback plan, and revenue came in pretty much in line. They reported $2.16 billion. The street was expecting $2.15 billion. So they actually did beat revenue and earnings expectations. However, they did lower guidance. The street was expecting $13.50. They came out and said, we're going to expect about $12.70 at the midpoint, and a double beat, lower guidance, but the stock is still up. That tells you everything you need to go. And this is the type of stuff you want to look for when we're putting in a bottom in the market. If you get a company lowering guidance and the stock actually rises, right, that is telling you everything you need to know. Everything is already priced in. And at that point, that is a major signal to buy. However, Constellation Brands is not going to move the needle. We need to see this type of stuff in some of these big tech names. CarMax was down 17% today, and used car stocks as a whole, Carvana, CarMax got absolutely pummeled. Now, CarMax reported quarterly earnings that missed the street's expectations on both the top line and the bottom line. However, they did repurchase 1.2 million worth of stocks, and they pretty much pegged this down to softening demand and higher car prices from Donald Trump's tariffs. Now, I get the softening demand stuff, but used car dealerships are actually winners in this tariff environment. So to actually say that they saw increased prices, I don't think the street's believing what they're saying, and that is why we saw the stock do what they did. I also don't believe they do issue guidance. I didn't see a guidance figure at all. And so the street was saying, hey, look, we don't really like what we're hearing from this management team. We're just going to sell the stock. And that is why the stock was down nearly 20% today. Brutal action. And to be honest, we saw brutal action in the market as a whole. 5,100 decliners, 1,100 advances. We did see inflows in the NASDAQ 100 and the New York Stock Exchange when the market did fall. And this really goes to show that, retail institutions and smart money were actually positioning themselves ahead of de-escalation. The second we get de-escalation with China, markets are going to rip. Again, the market played its hand yesterday. We know that's going to be the case, and investors are positioning themselves for that. And that is why we actually saw inflows in the NASDAQ 100 in the New York Stock Exchange on the backdrop when the S&P 500 did fall. We also did see market momentum hold up, kinda. 50% of stocks are still above their 5-day moving average. However, we did see deterioration in the medium term and shorter term averages. And ultimately, if we want to see regained market momentum, we need to see these levels approach the 50% mark. And that is not what we're seeing right now. And until that happens, markets will continue to churn and digest and be in a very volatile state of price action. Now, let's talk about the charts, guys. Very interesting day of trade. Brutal action in large caps, mid caps, and small caps. All stocks down in excess of like 3.5%, but looking kind of positive here in extended hours. No surprise right there. It does look like markets are trying to find their footing. It's just we are in an elevated volatility environment. For example, look at the VIX sitting at the 40 level of 21% today, and then we actually see the front-month VIX also at 27, but this is very, very interesting. This is still elevated volatility, but closer to what a normalized level is going to look like, because this is the front-month contract, this is the spot level. Essentially, what this is telling us is that the current volatility regime we're seeing has an expiration date. That expiration date is VIX expiration. That's a little bit later on in this month. It's the third last Wednesday or Friday of every single month. Despite the move we saw in stocks, yields actually rose, particularly the long end, but the shorter end did fall. That's very, very interesting. So bonds continue to get sold off. Stocks also continue to sold off. And again, it's a capital flight rotation away from the markets as a whole. And investors aren't even holding the dollar. The dollar actually fell as well. So we're seeing equity sold off, bonds sold off, and people aren't holding the dollar. They might be holding like the euro or some other currency. Very interesting. And the dollar here at the 100 mark. Very, very interesting times we're living in right now. Our risk parameters, Bitcoin was down 3%. Gold was up 3%. Silver was kind of flat-ish, up 0.81%. And then WTI and nat gas were down 4%. And again, this probably has to do with some of the initial demand. We're seeing a little bit of softening demand, and that's almost immediately reflected in the price of crude. But looking at the S&P 500, Very, very interesting situation that we're currently in. So if we actually look at this on a technical basis, right? Yesterday we said because we didn't actually go ahead and see the core wall move higher and we were at the top end of the range, we did expect a little bit of weakness and or digestion from the top right here. That's exactly what we said. And that's exactly what we got today. And now we're at the gamma flip zone right here. Very, very interesting trade. The bears won on the gap down. The bulls did come in a very, very big way. And ultimately, the structure doesn't look too encouraging. Yes, we did put in a low right here. However, despite the 10% rally we saw yesterday, this is actually a higher low relative to this high, this high, this high, this high right here. And look, for this move to be sustained, we want to see a retaking of like the 5,700 level. We didn't quite get that. So it does look like the trend is continuing to the downside despite this big move right here. However, if we want to see a break of the downside trend, a couple of things need to happen. We need to hold these lows that we made right here. And it does look like the bears did do that. We need to put in a higher low and then we need to go retake this high right here and then this high right here. But the first level would be actually getting a close above the 54.95 area, ultimately the 5,500 area. So if the bulls can go ahead and do that this week, next week, we just continue to see a move above 5,500 area and a close there. That will be positive. Close this gap, retake the 5,700 area. That would mean we do see higher prices and then we're firmly in an uptrend. However, if we continue to go ahead and drift lower and then break these lows right here, that is going to open up some very, very ugly levels and lower levels in the S&P 500 that we could see potentially as low as 4,100. So it really depends on what we see over the next couple of weeks. If we get price discovery at these lows right here and we don't break below, that is probably your signal to buy. If we don't actually go ahead and break below this wick low right here, or we stay in positive gamma, right? That is also a very positive development. We're in this weird state of limbo where we did make a higher low, but we didn't make a lower low. So ultimately we need the bears to either break to the upside or downside for us to determine what the direction is going to be. It's actually the exact same situation for the NASDAQ 100. It's just that the NASDAQ 100 did go ahead and break above this high and close that gap. And that is very, very interesting. However, we are in positive gamma and like the S&P 500, we're looking for more confirmation to the upside or downside before we actually go ahead and make our next move. Ultimately, as a longer term investor, 12, 24, 36 months down the track, you want to be deploying capital on some of the names you like. I like Nvidia, PayPal, I like Novo Nordisk, I like Evolution, EVVTY, I like Visa, I like Meta, I like all of these names. These are names I like and you want to hold for the very, very long term. But in the near term, the signals are very, very choppy and it's hard to determine where we are going to go next. The reason why we did see this move right here was markets were simply oversold. But like I said, the second we get de-escalation, guys, we are going to rip to the upside. And right now, I think all of the tariff escalation is already behind us. I think from here on out, we may get minor escalations in the tariff situation, but I think mostly we're going to see de-escalation rhetoric from here on out. And that is going to be positive for equities. The RTY, a very similar situation. I wouldn't trade the RTY right now at the moment. Longer term, yes, I do find the RTY attractive, but don't go out and buy the Russell 2000. Just go and buy the S&P 600. It's a far superior index, in my honest opinion. Looking at Bitcoin, we look at Bitcoin every single day on this channel. And that's because we have a very solid indicator, the global M2 money supply indicator. We offset it by 108 days. You can go ahead and get this indicator completely for free. You just need to have a TradingView account. I'm not affiliated with TradingView, by the way. And you could see here that if we actually just zoom out a little bit, guys, Bitcoin tends to track money supply very, very closely. This white line is Bitcoin. As Bitcoin trades sideways, so too does money supply. As money supply rips, so too does Bitcoin, and to the downside as well. Now, ultimately, if we just zoom in a little bit more right here, you can see that we are looking for a consolidation period in Bitcoin at these levels. Now, it's not a one-to-one signal, but we're looking for consolidation, sideways trade into the late April, early May period, and then we're looking for an absolute ripper to the upside, potentially retaking all-time highs here in Bitcoin. We actually did see quite a bit of a move here up in the global M2 money supply. So guys, once this happens, right, once we start to see life emerge in Bitcoin, I think that's going to bode very, very well for all of the risk asset stuff like the S&P 500 and NASDAQ 100. So start adding to your Bitcoin positions right here at these levels, right? And then you could actually add some pretty tight stops at like the 65,000 level. But yeah, you want to start building a Bitcoin position. I do have quite a lot of IBIT options that are expiring over the next couple of weeks. Hopefully, we
they expire in the money. I have them at $45. Where is IBIT right now? It's at $45.17. So it is out of the money at the moment, but if Bitcoin falls overnight, it could be in the money. I do have an IBIT option expiring tomorrow on Friday, and then next week and the week after next as well. Very, very interesting. I think Bitcoin's going to do very, very well. Let's quickly look at gold. We hit another all-time high, it seems, here for gold. Yes, we did. That's a close at the 3,176 area. It does look like this 2,900 area was a great buying op. I did say this was the first level you wanted to buy, and look at where you are right now. So it really goes to show that the market, there's still a lot of uncertainty, and that is why we're seeing gold rally. And we're also seeing very much the same in metals as a whole. Look, silver is not quite acting like gold, but we did see a move off the lows right here. Let's quickly look at the yield market. Yeah, yields finding resistance here at the 4.5% level, but yields continue to rise, and that's because bonds are getting sold off. And then the dollar, no surprise to see it at the 100 handle. That's exactly what we said we would see. In fact, if we see a little bit of price momentum in the dollar over the next couple of weeks, over the next couple of months, I wouldn't be surprised. I think we're at the low end of the range right here. I think we're going to see the dollar appreciate, if you ask me. But for all intents and purposes, guys, there isn't much to say with the S&P 500. Ultimately, look, technical levels, none of that is actually going to work. What you really want to focus on is two things. What are earnings looking like for the full year, and what's happening with the macro environment, particularly as it pertains to tariffs and trade policy. Those are the two things you need to be watching, because that's going to determine where we go. Other than that, if you're a very long-term investor, I continue to say buy the dip, don't trip.
And diving into sentiment, guys, we officially had a big tick up here in the fear and greed index. We were hovering at the 2 level literally yesterday. We're now at the 17 zone. So we are still in extreme fear, although some of that fear has abated. And that's because a lot of Trump's policies have also abated by the Trump admin. So if we are going to start to see some of these crazy policies unwound, we're going to see some of the extreme fear sentiment unwound. However, I do want to preface it that we are still in extreme fear. We are still in a period of heightened volatility. And until we actually get longer term certainty on the China situation, we are going to continue to trade in this extreme fear zone below the neutral zone. And in those instances, stocks can be very, very volatile. However, when looking at similar instances, when the S&P 500 has gained more than 5% on a single day, and yesterday we gained 9.5%. In fact, such instances are very, very rare and far and few between. What we actually see is that the next day and the next week tend to actually be fairly weak. 5 days, even up to a month out, we tend to see kind of flat returns. So we tend to front run the majority of the move. So if we continue to just trade at these highs that we're currently at in the S&P 500 over the next, I would say 2 to 3 weeks, that is completely normal. But when you look out 6 months, 12 months, you tend to see very robust returns with very robust hit rates. 10.8% return 6 months later with a 70% hit rate. 12 months later, you're up 26.9% on average and higher 91% of the time. So in other words, the breadth rush we had yesterday, expect near-term volatility, expect maybe even near-term downside, but do expect a longer-term price appreciation, especially as the further along the year we go. But ultimately, what is going to determine the path of equities is S&P 500 earnings growth. And this is the latest updated calendar 2025 earnings. And we actually haven't had a change from yesterday. It's exactly the same. We're still looking at 11.3% earnings growth. Guys, this is FactSet's numbers most up to date as in today. So we're still looking at double-digit growth for the year. We haven't seen any major earnings revisions. And even if we do, the truth of the matter is EPS tends to bottom about 13 months after we hit a low in the S&P 500. So the low we saw at the start of this week could very much be the low we actually get for a very, very long time. And that is why you want to buy the dip viciously when we do make such moves in the S&P 500. And a general rule of thumb I use is every 5% pullback in the S&P 500, that is when you want to deploy capital. So 5%, right, at 10%, at 15%, and at 20%. This way, you'll get the most bang for your buck. Your dollar cost average at
pretty good intervals and you won't miss those sharp bottom moves. But ultimately, we do want to look at the macro because we do know that when we do get a bear market that's not followed by a recession, stocks do very, very well. And by the looks of it, there isn't recession signs anywhere. Bloomberg's GDP growth forecast, this is real GDP growth, is sitting at 2% right here, down from the 2.3% mark, but we're not seeing any signs of a recession just yet. And looking at federal employment tax receipts, we saw 15.9% growth here in April. Absolutely huge. Now, I know this is only a couple of days into April, and I will keep you guys updated with the latest stats. However, we are seeing some very positive signs in the economy as well as GDP. However, we can't discount the fact that there is still an immense amount of uncertainty. And this is a note we got from Goldman Sachs. Lifting the duties on China to 125% and reducing the others to 10% would lower the average US tariff rate to 24% from 27%. So even though we have lowered the overall tariff rate, it's still fairly elevated. That means the overall impact to the US economy isn't expected to be much different from the earlier announcements, with the average tariff rate up almost 22 percentage points since Trump started his second term. So there is this uncertainty. Now we do have to see how this goes, but ultimately I think what the market is looking at is that this 125% figure probably looks like a ceiling right now, and it probably will go down. Also, what this is telling us right here is that China tariffs make up the majority of this 24 to 27% tariff rate. And if we do see this come down, this 125% level, if that comes down in a material way, this number is going to come down in a material way as well. And I think that is what the market is projecting. And that is why we saw the rally we did in stocks in the last couple of days, an insane rally. And I'm all here for it. Now, looking at earnings and data for the rest of the week, tomorrow is the big one, guys. JP Morgan, BlackRock, Wells Fargo, BNY, Morgan Stanley, Fastenal. They're all reporting before the bell on Friday. So we're going to get a good glimpse into what earnings season is going to look like. This is the litmus test for this quarter. And then looking at data tomorrow, we get the PPI. We kind of already know the numbers because of the CPI. We also get the Michigan consumer sentiment and a couple of Fed speakers. But if you've made it up until here, thank you so much for watching. If you like the video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.